Hi, everyone. Thanks for waiting and welcome to the Great Rotation webinar built to beat the ASX 200. And we're talking about the Intelligent Investor Australian Equity Growth Fund. And it's part of the secondary offer that's running at the moment where we offer it direct to investors to invest, which means there's no brokerage and there's no spread. So you get units inside this fund at the net asset value. I'm Tom Wilson and we'll be joined shortly by Nathan Bell, who's the portfolio manager. We've also got Mitch Datson there in the comment section. So if you've got any questions, he'll try and answer them as we go. But as always, just the disclaimer, we provide general product advice, general advice only, not any type of personal financial advice in these webinars. So I'll quickly run through the actual offer that this whole webinar is based around, and then I'll bring Nathan on in. But basically the offer period is from the 12th of May, so it's already started, and it runs until the 23rd of May, 5 p.m. And that's on a Friday. And that just means that if you decide to take up units inside this growth fund, you actually get them at the net asset value, no brokerage, no buy-sell spread, minimum $2,000 investment, and you can actually get them sent to your SRN number. So sorry, your HIN, holder identification number. So if you've got a shared brokerage account, make sure to enter that in and it can get sent straight across. We'll run through this as well. There's also the offer page, there's a QR code there, but you can also go to the intelligentinvestor.com.au website and you'll be able to see it at the top of the screen. Now, without any further ado, I'll bring Nathan Bell in. Nathan, thank you so much for joining us.
Thanks, Tom.
Okay, I'll let you take over the slides. And as always, everyone, if you've got questions, definitely ask away. We'll do our very best to try and get to most of them. And we'll try and weave them through at the same time. So thanks very much.
So I've got so many slides today that it would be a challenge for our colleague Alan Kohler to come up with as many charts. But there's a couple of things I want to go through before we actually get into the formal presentation. I've called this presentation I've got to go back. Hang on. I've called it the Great Rotation, built to beat the ASX 200, which goes without saying. But obviously the great rotation is to come, and that's what I'm going to talk about. But at the moment, it's the great frustration. It's been since our performance peaked. I think we were doing about 8% outperformance a year for 4 years after I got back between 2019 and 2022. And then the last 2.5 years, as I'm going to explain, the market's become quite distorted. And if you have a look at our performance chart, which I will do in a minute, looks like we've actually been blowing people's money up recently, which is far from the case. When you see a fund that's very conservative, very high quality, when you see it outperforming by double digits in 1 year, which I don't even think has happened when I've ever managed a portfolio before, you know, something's actually distorted in the market rather than anything we're doing wrong. So I'm going to talk about that, and but trust me, there's a silver lining to all this, which is that we've actually got a potential opportunity that we only actually see once in a decade. So I've got a whole bunch of charts that we're going to start at the top. We're going to look at see what's been driving the index, then we'll see what's been driving our returns, or lack of returns, and then we'll get down to all the stocks. So by the end of it, it is a lot of slides, but you'll get a copy as well. But they're not complicated, and I think there's a few key themes that will stick out. But the main thrust of today's presentation is that the prize for leaving the herd and being contrarian is about as big as it gets once a decade. But before that, there's a couple of things I wanted to point out. The first is that we've made an application to the ASX, and on 1 July, we should be able to invest up to 30% of the fund in overseas listed stocks. So this is the same thing we've done with our ethical fund, and it's completely rejuvenated the returns there within a year. There's a whole bunch of reasons we're doing this, but obviously it's no work for us because we already know the stocks. And it means that we can replace things like BHP and Woolworths, which are hardly what you think of when you think of as growth stocks. But because the premiums you have to pay in Australia for the REA groups and Technology One, you know, these are 50 times earnings, or Technology One's trading at 20 times revenue. And you can actually buy Visa and MasterCard and Amazon for cheaper than what you can get Woolies for. So this will actually put us on an even footing with a lot of other funds that have been doing this for the last 20 years. So I've actually wanted this change basically since 2014, back when we just had model portfolios and running the subscription business. So I'm absolutely delighted with this. Just in terms, if anyone's worried about the US exposure and what the orange tsunami might mean, we can hedge the currency, because that's where the real risk is, I think, is the currency. So we can hedge that. So don't worry about that. But also, even if we go up to 30% international, it really is international at the moment. It's not like we're going to the US. And actually, for the big US stocks, Trump actually might be good for them anyway, because he's trying to reduce regulation and reduce corporate tax rates. So don't just think Trump is bad for America. America is still the powerhouse for innovation and great businesses and well-run companies. So that's what we're going to hopefully be able to do on 1 July. It basically rejuvenated our ethical fund when we did this within about 10 months. So I don't want to promise it's going to fix everything in 10 months, but if you think about owning businesses for decades, when you've got some businesses on return on equities of 40, 50%, and growing earnings in the teens, that's obviously a far better bet. Obviously, as long as the valuation's okay, than the couple of stocks that we're forced to own at the moment, because we're having to buy the value, and the value is pushing us into stocks that what I term as yesterday's heroes. And you can't really expect much growth out of Woolworths or BHP and these sort of businesses. But the really great growth stocks in Australia at the moment are just so crazily priced. I don't want to be going to bed every night waiting for a 30, 40 or 50% fall in these stocks to go back to normal. I'd much rather be underperforming, knowing that we own the stocks that are going to go up 50% or 100% or multiple times their current value eventually. And essentially, that's the price we're paying at the moment for value investors, and our performance pretty much looks like any other good value investor. So that's going to be a change from 1 July. But if you've got any questions about that, feel free to ask after I do the formal presentation. And if you're interested in knowing potentially what the stocks will probably be, then have a look at our ethical fund. It'll probably be very similar to that. But I won't say any more on the stocks today, because there's just so many other things I want to get through today. So I got this quote from Dan Loeb, and it says, "I've said before that they don't ring a bell when the rules of the games are changing, but if you listen closely, you can hear a dog whistle." And I thought, I feel like we've been in the doghouse for the last 2.5 years. I'd love to go back in time and sell our coal stocks and mineral resources after we've made big gains on them, because not selling those 3 stocks and not owning banks has cost us about 20% in performance alone. So just from those few decisions. So it's quite frustrating, because we think those, as I'm going to talk about, we think our stocks are extraordinarily cheap. And not in the case of MinRes, but the other resource stocks we own are paying out big dividends, buying back stocks at ridiculously low earnings multiple and adding plenty of value. And yet I thought in late February, when Satya Nadella, the boss of Microsoft, came out and scared the market, I think basically everyone thought the AI boom or bubble was going to pop. And all of a sudden the banks started going down, and within 3 weeks, we had our 5 best days of outperformance in the last 2.5 years. And I thought, finally, we're going to get back to our old ways of winning. And then Liberation Day came, the market went sideways, and I thought, this is great, this is going to have to change. And then what did the market decide at the end of that? Well, we should pay even more for Commonwealth Bank, pushed it up to 30 times earnings, and kept buying Pro Medicus. So the great frustration goes on, but we've been through these periods 3 or 4 times before, and they all end the same. So hopefully we're nearing the end of that. And I want to show you today is not just about what our performance would look like when things change, but just I really want to try and quantify the size of the change, because it's unusually large in terms of the outperformance that's there over the next few years. So just for the performance, I just wanted to show the performance slide. This is what I showed last year. And you can see that's a very respectable history of performance. The only thing that I would want over and above those numbers is I want that since inception number at 3%, the outperformance at 3%. 2% is great. If we can do that forever, then we're adding lots of value to your portfolio and to your savings over time. But I really believe we should be doing 3%, given the advantages we've got as a fairly small fund. But because we've got a fairly limited history, and you can see what happens when you have 1 year where you're completely out of whack with the market, and all of a sudden we're back in line with the index. So it's extraordinarily frustrating. But in the middle of last year, when I was on holiday in August, I almost felt like tearing my hair out. It's the first time I've been a portfolio manager and really had this frustration. We've normally been going really well. And then it got to Christmas, and I remember just sitting there on the couch, and I just realised that there's nothing I can do about when the market wants to do silly things. And I thought about stories that I read about where Julian Robertson, who was the titan of the hedge fund industry, he's basically credited with creating it. He basically shut down his fund in the middle of 1999 when the tech boom was at its fiercest. And what we're going through at the moment is frustrating, but it's nowhere near, I imagine, as bad as what that was, when everyone was just making crazy money out of IPOs, where there was never any chance that any of these businesses were actually going to make any revenue, let alone profits. And he finally gave up. He just threw in the towel, so I've had enough. And 6 months later, the tech boom crashed, and he was right. He just had to hang in there at the end. So I try to think of those types of people, and Stanley Druckenmiller, who's widely regarded as perhaps the greatest speculator of all time. And any time you spend listening to him is time well worth spent. He got to, it was basically like, I think it was like literally the day or two before the tech boom turned to the crash. And he just couldn't take it anymore. And he put a heap of money into the market, and he lost $6 billion almost instantaneously. So the thing I take out of those situations is that these are the greatest investing minds that we've ever had, and even the pressure gets to them. So I just realised at Christmas, look, there's nothing I can do about industry funds and overseas funds wanting to bid up Commonwealth Bank to 30 times. All we can do is make sure we're investing in the right stocks, so that eventually when the market comes around to its senses, that we've got the right stocks, so we get that since inception number out to 3%. And so that's what I really want to focus on today. So I've talked about the recent performance. Obviously I like to go back in time and sell our resources stocks and buy them back now. Or maybe buy back Mineral Resources about 2 weeks ago, because it's up nearly 100% in the last little bit. CBA is now, depending on which index you look at, is between 10 and 12% of the index alone, which just blows my mind, because it came out with its results and it was 1% growth and it's still trading at 30 times earnings almost. And actually augurs poorly for its future returns, because BHP and CSL are the last two companies that became 10% of the index. And we've seen what happened to their returns ever since then. BHP is down, and CSL share price is down or hasn't gone anywhere for 5 or 6 years now. So as I said, if we can just get the value back from our resources stocks and the banks go back to normal, that alone is going to add 20% to our performance, and that'll restore our performance. But actually, again, the thrust of today's webinar is actually the opportunity for value investors is much, much bigger than that. So let's just have a quick look at the index so you can get a look at what we've been competing against. So since 23, so basically the last 2 years, the market has increased 25%, and we're now, compared to the long-term average, we're about 20% overvalued. So where's that overvaluation coming from? Well, it's not coming from earnings going up, that's for sure. This chart doesn't do it very well, so I do apologise for that. But the main thing you need to take out of it is, for the past 3 years, earnings for the index have fallen. And next year, the market has priced in a 6.6% increase in earnings, which maybe that happens. But given the banks' earnings as a group are going backwards, iron ore miners are struggling against a lower iron ore price, and now we've got global growth slowing, that seems pretty optimistic to me. So we might have a fourth year of earnings going nowhere. So why has the market gone up? Well, it's gone up simply because of animal spirits and the fact that the people are just willing to pay much more for the stocks than they were before. And so now we've got this situation where there are two big sectors that are causing the overvaluation. The first is the industrials, which are trading at an average price to earnings ratio, which is 30% above the 20-year average. So that's hardly surprising, because we've got banks, for example, trading at huge premiums, Commonwealth Bank and NAB in particular. We've got our tech companies that are trading at double the multiple that they usually trade at. I mentioned a few of those names already. And then you've got things like Wesfarmers, which is 3 or 4% of the index, trading at, I thought like we'd been kissed on the bum with when we sold it at, I think it was like 30 times earnings and $77 a share. And now it's back up to $80. This is a retail business that used to trade at 15 or even 20 times earnings. And we've got other retailers like GB Hi-Fi that used to trade at 10 times earnings, now trading at 22, 23 times earnings. So, there might be some of those stocks that actually deserve that. Maybe JB Hi-Fi is one that's actually genuinely been undervalued over the last decade. But we've just got a whole bunch of these stocks now trading at valuations that even if they perform brilliantly, it's going to be really hard for them to live up to those multiples. And obviously it makes absolutely no sense that when you've got companies that offer no growth trading at big premiums. And here's the situation with the banks. So you can see that they're way above the average, mainly driven by CBA, but also NAB. So they're trading, even further than 20%. I think they're the maths above the average. And remember, even if they just go back to average, it doesn't mean they're cheap. It just means that they're still low to no growth, and they still trade at a reasonable premium compared to the past. And yet, in last year's slides, I won't go into it today, but I talked about why there's reasons that the banks should actually be valued lower now than what they have been in the past. They don't deserve the big premiums because they're not even growing anymore. And actually, most of their earnings are going backwards. And now it looks like interest rates are going to go down, which is bad for their profit margins. So it really doesn't make any sense from a valuation perspective. But the reason they're going up is actually not because retail punters have been unwilling to sell their stocks. Like there's definitely some of those people that don't want to crystallise the capital gains. But there are charts showing that Australian investors have actually been selling them, which is actually absolutely the right thing to do and locking in those profits because you never know when you're going to see these prices again. But then we've got companies like MA Financial, which are obviously not as safe as CBA in that sense and far more volatile as a small stock. But you would have thought if a financial company was going to trade at 30 times earnings, it would be the company that's poised to grow its earnings, double its earnings over the next 3 years, not the one that's growing them at 1%. That's assuming everything goes right. And we know with the banks, not everything always goes right. Like there's always a cycle to them. They're highly leveraged and they're absolutely, their bad debts are absolutely as low as they go at the moment. They're doing everything they possibly can to pay every dollar of profit out as earnings, which means there's nothing being reinvested in the business. So you can't expect any growth anyway. So the moral of the story really is we've just got these tech sector in particular and the banks and just in those high quality, sort of the Warren Buffett stocks, if you like, everyone's just piling into those stocks and ignoring valuations. So when the cycle turns, and I think we're going to go through a period probably like 99, 2000, which I'll talk about in a moment, where people actually switch to where they're going to make money. At some point, the market wakes up and realizes this is not where we're going to make money, and actually we might actually lose money paying these valuations or make really poor returns, and then all of a sudden everybody rushes the exit. No one gives you a warning when it happens, but it can happen very fast. And you can only imagine what's going to happen when all the passive and index and industry super funds, which I'll also talk about in a moment, all rush the exit at the same time. We're just looking at the question there.
I was just saying that there's a good comment there, I think, which is reinforcing what you're saying just about the superannuation super, having to go into those stocks like CBA, for example, and the increases that are coming. But I know you're going to talk about this in a moment too.
Yes. So actually, let's just leave it there and we'll move on so I can get into the detail. So that's a great point there by BK. I just wanted to put in this line. I didn't really appreciate, this is only one of the probably 2 or 3 things driving the banks and CBA's share price. Like one of them is obviously people just getting out of iron ore miners. And if you've got serious institutional, billions upon billions of dollars to move somewhere else, in Australia, you don't really have anywhere else to move it other than the banks because they're the only stocks that are big enough to take that sort of money. I think CBA is like a $250 billion company at the moment. So it's not surprising. But there are actually reasons, and again, I've got slides for this, of actually why you actually might want to be a bit contrarian at the moment. But there's also a lot of foreign investors at the moment that are escaping the US and escaping Trump, and they're just looking somewhere to hide their money, where they feel like they're not going to lose money. They're not buying CBA because they think they're going to get high returns. They're just buying it because they just want to hide out somewhere. Particularly for Asian countries and Asian investors, they really see Australia as a safe place. And there's good reasons for that. There's the rule of law. Our market's nowhere near as volatile as Asian markets. You see this Aussie market hardly move sometimes. Then you see the Hang Seng indexes move by 3 or 4% in a day. It's pretty wild stuff. So, the world's increasingly more global, and we've got passive and industry funds that just have to buy these stocks when they go up. And that's what this point here is about. I didn't quite appreciate just how prohibitive this is for industry super funds, which is such a huge part of our market now. So unintended consequences. So ScoMo brought in the your super, your future rule. And it's one of those well-meaning things. It was designed to hamstring low-performing funds. And, that's a good thing. We want everyone to be outperforming over time. We don't want poor managers out there managing people's money. But the way he did this was, and I'll just read off the slide, it says, where a product fails the performance test in 2 consecutive years, the RSC licensee will be prohibited from accepting new beneficiaries into the product. So we would have been out of business decades ago if we had to subscribe to this, because we're out of the market for more than 2 years lots of times. That's essentially almost what defines being a value investor is. So there is no way in the world an industry super fund cannot be in line with the index now. So if CBA is going up, it doesn't matter what the reason is, the industry super funds have to buy them, all right, because they don't want to have to stop taking in new customers, as you can imagine. And I just provided this little comment, which I just found in an article. Someone said, I haven't got the author there. It's sort of pointing out the obvious, but the article, I think it was late last year, says there is evidence that the test may be influencing investment decisions to the detriment of member outcomes, including discouraging investment in asset classes that may otherwise be in the best financial interests of members. So it's sort of one of those moments. Of course, you set the incentives up to not fail, and that also takes away the ability for these funds to outperform. And so I asked Arne, one of my helpful colleagues, to do me a nice little chart. I just wanted to show, we see these ads about compare the pair all the time. And it's also the one, I think it might be CBUS, but I might have that wrong. And it has the handle, the little triangle showing that they've done 8.9% for 20 years or whatever it is, which is absolutely, fantastic return for their members. But can you imagine that they went out there and they told everybody that they were buying these massive amounts of CBA, where the best that they could earn over the next decade is 4% a year, or they were piling all their money into the banks as a group, and the best that they could hope for, assuming everything went well, is probably 5% total return per year for the next decade. All of a sudden, you're not going to see these happy people with their little hands in the triangles. So I just thought that was worth pointing out, because that's the reality. That's the reality that's been forced on them, whether they like it or not. So that's why you're getting, this world of passive funds and index funds and industry super funds just having this, or creating these huge distortions in the market. And that really explains the last 12 months of our performance. Not to say we haven't made mistakes. Again, I'd love to sell those resources stocks a couple of years ago. But, the time for being frustrated and worrying is over, because we're at such an extreme now, and we understand why these things are happening. And we know the stock market has a 100% strike rate of bringing these stocks back to fair value at some point. So we just have to wait. So this is what I was talking about earlier, when I've got a couple of slides showing different aspects of how extreme the market is at the moment. And this is one that shows the extreme valuation of growth stocks compared to value. And I think last year, or it might have been the 12 months before that, was actually, I think it was either the worst or the second worst year for value stocks on record. So again, I just can't sort of reinforce enough just how extreme the pricing is in the market at the moment. And we're going to get down to some individual stocks shortly. But just look at that blue line. Like, we've only seen it, it's so extreme, and we've only seen it 3 times in the last 25 years. And one of them was the tech boom. And the other one was just before COVID hit. And then you can see, value did quite well in the aftermath, but and it's been just all one-way growth. And just remember what I said, like there are individual stocks that absolutely deserve to have gone up in that period. REA, you can argue whether it's worth $250, but it's certainly worth $200, and traded at about 110 or something at the lowest, in sort of 21, 22. But the market as a whole, remember that the increase has all been built on hot air, because there's been no earnings growth over that period. So I just thought I'd pull out this other slide too. This is more just what I would use as a measure of animal spirits in the market, which can be quite useful. The most simplest way you can measure animal spirits these days is just to look at the Bitcoin share price. Bitcoin price. That's the easiest way, because that's just where you see these particular stocks these days. Pro Medicus is one, WiseTech's another, that when everyone's confident and they want to bid stocks up, these are the particular stocks that go up in Australia. But I just thought I'd read out this because it's very rare you see the amount of anomalies in the market that we're seeing right now altogether. It's a really rare period in history. So this is a quote from Dan Lissick, and he said, so this was at the end of March, said during the quarter, the total market cap of stocks with price to sales greater than 20, so that's not price to earnings, this is price to sales, greater than 20 times reached an all-time high, $6 trillion US. That's 1 trillion higher than 2022's peak, and is nearly 2 times the .com peak. As Kadish Capital recently highlighted, one has had 2 times better odds at a casino than having success investing in stocks with valuation multiples over 20 times sales over the long term. So normally in the past, I probably would have been quite frightened about that and what it means for the market. But actually, because of this dichotomy of the market where the money's just all going to these particular groups of stocks, I'm actually far more excited than maybe I should be. This is actually what makes me excited. So this is the US market, and this shows the period from 2000 to 2006 in the aftermath of the .com crash or .com boom, depending on how you look at it. And this was a period when a lot of very famous US investors actually became famous from the returns they generated during this period. And a lot of them actually haven't been able to do it since. Interestingly, Bruce Berkowitz was a huge name when I was coming through Intel's Investor in 2006. And I think Morningstar made him the fund manager of the decade. And since he was buying AIG, I think he put something crazy like half his fund or 3/4 of his fund into AIG or something after the GFC, and hasn't worked out that great. But you don't really hear about him anymore. But this was just an amazing period for value investors. And depending on how small you were prepared to go, determines how much you outperform. But the one line I want to point out to start with is that bottom line. Large growth, annualized returns over the 6 years, minus 5%. The cumulative returns was down 30%. And if you believe, like I do, the couple of the best forecasters, Jeremy Grantham and a couple of others in the market, that suggest where US valuation should be for large cap, that's basically almost bang in line where they say they should be. And you can see it doesn't necessarily happen overnight. Sometimes it might happen very quickly, but sometimes it just happens over a bunch of years where the money just gets slowly frustrated being in stocks that aren't going anywhere because the stocks have to catch up. The earnings have to catch up to their huge valuations, but eventually ends up in value stocks. And you can see if you're large value, then you made 8% return over those 6 years, but that's outperformance of 13% a year for 6 years. So that's nearly, sort of 70 or 80% outperformance. And that was if you're in large cap. If you're in mid cap, you did 14% a year. And these are just enormous numbers to outperform by over a long period. And small value was even more extreme. You see the outperformance there was 20% a year for 6 years. Now, obviously, we're not small value, but we're somewhere, I'd say, in that sort of mid cap value. And maybe things aren't as extreme as back then, but I certainly think the future will rhyme with this period. So the fact that we're actually starting from in line with the market and these are the potential returns, or at least they rhyme with these sort of returns in the next cycle, at least that's what I believe, we should be feeling pretty good about ourselves. The question is, have we got the right stocks? And that's what I want to jump into today. So just a bit of a summary here as we're sort of getting deep into the slides. I think if the banks and Macquarie go back to regular valuations, I actually think that could give us 10% back of our performance alone, just from us not doing it, just avoiding those stocks. We've got resources stocks, as I'm going to show you in a minute, where I think there's 20% potential outperformance in those, just from those stocks. We've got small caps, again, which I've got more slides, which I'll try and speed up to get through shortly. And I think just what I call the reliable quality, I think is what's getting also undervalued a little bit at the moment, because everyone wants to be in the exciting stuff, and it's leaving some really it's actually leaving the former market darlings at prices we haven't seen for a decade. So if you add all those up, you can just get a sense for just how big the outperformance could be. So the question is, have we got the right stocks? And I think the one thing we need to guard against as the cycle eventually changes is we just need to make sure we don't jump onto the great darling stocks too early. I think that'll be the mistake. We sort of get excited when, like a Reese, for example, has fallen almost in half. It fell from $28 to $14. And I think I talked about this in last year's slides about just how ridiculous the valuation was. But it fell to $14 and it was still expensive, and its competitive advantages were falling in the US. So you've got to be careful about not just buying stocks just because they've fallen a lot. So I love this quote. Experience is a marvelous thing. It enables you to recognize a mistake whenever you make it again. And anyone who's followed me throughout my career will know I tend to stay away from resources stocks for exactly the reason we've gone through the last 2 years, because if it wasn't for them, our performance would look probably fine, although the banks have obviously hurt us as well. But this is not the time to sell them. Like, have a look at that chart. We have, as a group, we haven't seen commodities this low compared to other stocks since the 1960s. And the world is going to need more oil. Like, you can talk about, again, like if you want a green fund, then we've got our ethical fund. So if you're an ESG investor, you might want to skip this next few minutes. But we still need commodities in our world for all sorts of reasons. It isn't just for gasoline, like oil's used in plastics and all sorts of other things. And yes, we need to try and get to a world without them, but that's going to be a very long road. And when you see commodity prices like this, it means the commodity producers aren't going to spend a lot of money investing in new projects, because why would they when the prices are so low? So this sort of reinforces the valuations of these stocks, and the market just has absolutely no interest in some of these stocks. And believe me, I can't wait to sell these resources stocks and move on. They've been the most painful thing I've ever gone through in my career. But I just wanted to very quickly talk about some of these stocks. So this is a relatively small proportion of our portfolio, but the potential gains could be huge. That 13% is actually 15% at the moment, because mineral resources has doubled off the bottom virtually in the last month or so. But it's got a long way to go. We still think this could go up threefold from where it is today, if it doesn't have to raise capital. And if it does have to raise capital, it's still going to be worth more than what it is today. But you've seen what happens, just a little bit of a change in the story with the iron ore price going up a little bit. And now there's more confidence that the tariffs aren't going to be as big a burden as before, and China's going to stimulate. Well, that's going to be very good for resources stocks. And the market is very, very underweight resources stocks. And you can tell that simply just because of what's happening in the banks. Like, that's where the money all is. So if all of a sudden that swung the other way, which is essentially what's happened over the last 2.5 years, is the money's just evaporated from any exposure to China and it's gone into the banks. If that goes the other way, then these stocks are going to be worth much, much more. Again, I don't like talking about coal stocks. It doesn't fill me with joy owning a coal stock. But I just want to show you this next slide. New Hope is currently trading on a 10% fully franked dividend. It's a low-cost producer, and the coal prices are basically eating into the cost curve now, to the point where a lot of other higher-cost coal producers are curtailing production and removing supply. So that's exactly what we want to see. And quite amazingly, from 23 to 26, 27, New Hope coal is actually going to double its production, which is normally extraordinarily hard to do. So you can only, like, the share price got to $7.50 during the sort of peak of the fear around Ukraine and supplies of commodities. Like, the equivalent would basically have been that it was a $15 stock with that sort of production. And at the moment it trades at $3.50 or $3.80. I think it's gone up the last couple of days. So you're getting a 10% fully franked dividend, assuming coal prices stay where they are, to wait for this production to increase. And it's buying back shares at 6 times earnings, or that's the equivalent of a 17% yield. So these are just like extraordinary numbers that you just don't normally see. It takes something quite abnormal to create these sort of values. So, I can't wait to sell these stocks at some point. But at the moment, Karoon Energy is buying back stock at 4 times earnings. It's paying about 7% dividend yield at the moment, and its production is set to increase materially as well. Thanks to some agitation by investors, they've changed the incentives for the business, and it's buying back shares as well at 4 times earnings, which is equivalent of a 25% yield. Like, this is just remarkable stuff. These aren't, just crappy resources stocks with pie in the sky developments that may or may not work out. And these are companies that are producing enormous amounts of cash right now, and they're paying it out to shareholders, and they're buying back shares at ridiculously low valuations. So this is not the time to sell them. I'm not going to go through it, but Whitehaven Coal, what management has done over the last 2.5 years to reposition that business has been quite incredible. But it's not paying out the big dividends like New Hope, and it's not as cheap because it has higher costs than New Hope. But this is not the point to sell them. But it's been the frustration of the portfolio for the last 2 years. But when actual people come back to these stocks, there's a huge amount of value here. So we think from like this 14 or 15% of the portfolio, we can potentially generate 20% of outperformance. So this is not the time to sell them. This is the performance of the small cap stocks in Australia versus the market. And you can see normally small caps through this sort of period would have been outperforming by a long way. It actually hasn't been the case. And I think that's just because investors have been a bit scared and they just want to, they want the quality, they want the safety of the quality. But that comes at a price. And so we've got these half a dozen stocks ranging from RPM Global, which is about a $700 million company that's already got 4 years of sales in its software business already booked. We've got these half a dozen stocks ranging, as I said, 600 market cap at RPM Global, but ranging up to about $2 billion for Lovisa. So when I say small cap stocks, I don't mean burnout, terrible micro risky stocks. Like these are businesses that are well established, got owners running them, got their money all invested in them. And these are very high quality and they're paying out big dividends. In fact, Lovisa and MA Financial are two of the biggest, what I would say, dividend payers in the market, yet alone amongst small cap stocks. Aussie Broadband just paid its first dividend. RPM Global is just buying stock hand over fist. It's got cash on the balance sheet. Indica Data is the cheapest it's been in about 5 or 6 years. Well-established business, great little niche business, trading cheaply, and it pays most of its profits out as dividends, so you can't expect huge growth, but it still should be able to grow at 5 or 6% a year, and it's paying out about a 6% fully franked dividend yield. So you just don't get to buy these sort of stocks normally at these sort of valuations, and there seems to be a bit of fear around MA Financial, I think because of the private equity is growing so fast that it's been sort of tainted with the brush that everything private credit is bad. But this is a stock where, unless we get a really severe recession, is poised to potentially double its earnings over the next 3 years and potentially trades on 13 times earnings looking a year or two out. And it always increases its dividends along with earnings. So the cash always comes out to investors. So again, like I said earlier, like if there was a company, a financial that I thought should trade at 30 times earnings, it's not CBA, it would be MA Financial. And just because like it doubles its earnings in 3 years doesn't mean MA Financial Group's future is finished and also it's going to be low growth. This is I don't expect it to be as good as Macquarie, but it is like buying Macquarie sort of back in 1980, if things go well. And this is the last one, and then we'll get to the Q&A, but this is a chart that I have borrowed from Platinum Asset Management, and it looks a little bit complicated, but what it's basically saying is that normally when investors buy risky stocks, they expect to get higher returns. But what's actually happening at the moment is the valuations for those high quality businesses have been bid so high that actually the relationship has flipped, where you can actually buy less risky businesses now and get higher expected returns. So this is basically manna from heaven from value investors. Like this is the whole, what the Bible of investing is about, trying to reduce your risk and increasing your returns at the same time. So what's a good example of that in the Australian market? Well, ResMed, CSL and Sonic Healthcare. When I started at Intelligent Investor in 2006, these became the darling stocks. These are the stocks everybody wanted to own. And obviously they're not growing as fast as what they used to, but ResMed's growing its earnings double digit and trading about 21 times earnings, even though its share price has nearly doubled since the GLP-1 drug scare sort of 12, 18 months ago. We would never used to be able to buy ResMed at 21 times earnings. And why on earth would you be able to buy ResMed at 21 times earnings when Commonwealth Bank trades at nearly 30? It just doesn't make any sense whatsoever. CSL has had its problems and it made a poor acquisition and it's not as good a business as it used to be. But it also trades at 21 times earnings now as well. It's expecting double-digit growth, as far as the eye can see at the moment. And Sonic Healthcare, not as good as business as those two, but again, trading at that sort of 20 times earnings. And for the first time in quite a while, it's underlying business that doesn't come from COVID jabs, which is all gone now. Actually, it's looking like it'll be able to increase margins. So there should be a good story there over the next few years. Again, we've got, except for CSL, we've got managers with skin in the game. And these used to be the darlings of the market. And now you can buy them for prices that you sort of always dreamed of in the past. That's the chart of the PE ratios for the three. So you can see how far they've come down for CSL and ResMed. The Sonic one looks a bit funny because its price to earnings ratio shrunk because of all the money it was making out of COVID testing. But now that COVID testing has gone. Now you're getting back to a much more normal PE and normal earnings. But the key point is, before COVID, the margins were under pressure for Sonic, but Sonic's been able to take all the money it made during COVID and plough that into increasing its scale in places like Germany and the US. So there should be a good story for Sonic over the next 5 years. Again, it doesn't grow that fast, but we're looking for nice, solid businesses that can potentially create 10% returns as safely as possible, and that's a good example. So that's it. I realise there's a lot of slides there, and I've talked quite quickly to get through it, but you'll get a copy of the slides, and as always, you can ask us questions even if you don't get them answered today. But just in summary, it's all about the great rotation. You can see the value in the fund. So you look at the last 12 months of performance and you think we must have been blowing up people's money. But you look at the stocks we own, and it's just that the market has absolutely no interest in those stocks and wants to keep buying Pro Medicus and WiseTech and Commonwealth Bank. So when that changes, and we know that it will at some stage, I just don't know when, I feel like we're in the box seat. I'm really happy with the stocks we own, even though it's been a painful 2.5 years. But I thought there's just, you never know when things are going to change, and I don't want to sit here and predict what's going to change the market's mind. But the main thing is we just put up with the pain now, knowing that we've got the right stocks, and keep trying to add to those great stocks when we get opportunities like earlier in April. But here's a few things to look out for that might help. Lower interest rates, that's usually good for cyclical stocks like some of the ones we own. Profit downgrades, we're seeing a lot of them in the US already. And obviously the stocks that are in vogue at the moment, they really have to deliver good numbers just to justify their current valuation. So any downgrades are going to be met pretty harshly with. China stimulus, I think that potentially could help. We're seeing the iron ore price up a little bit at the moment. Whether that's sustainable, there's a lot of supply coming on next year. And you'll note that I didn't include our BHP holding in that group of resource stocks because we've got what I call a sort of hedged position at the moment. It's about 7% of the fund, and I think BHP is about 10 or 12% of the index. But the 3 iron ore miners are about 20% of the index normally, but we're well short iron ore miners. I don't think that's where we want to be, and not certainly as growth investors in the future, because there's big supply coming on next year. But in case anyone's wondering, for mineral resources, if they can enjoy current iron ore prices, then that's going to be great for their new iron ore Onslow project. They just need to get the debt down. So it's a very different situation to buying BHP, where they'll mint a lot of money, but whether they can actually grow earnings does depend on the iron ore price. Increased corporate activity, I think, will be good for some of our small cap stocks, but that's probably been put on hold a little bit at the moment because of the orange tsunami. I don't know what else is going to come from the Trump world, but we've got 3.5 years at least left to it, and something tells me he's not going to go away quietly. So we just have to live with the volatility. But the one thing that's really quite different, I think, in the market these days, and that's what makes our recent performance look more funny than usual, is that we've just got such massive extremes in the market driven by passive investing and the impact of industry super funds, where we're now getting cycles that are much, much shorter than they used to be, but they're far more extreme and far more rapid. So we just have to make sure we're trying to be on the right side of that. And that basically just means we're going to have to sometimes act a bit quicker than what we used to. But the one thing that doesn't change is if you own cheap stocks, eventually you get rewarded. So again, a few takeaways, and then we get into the questions. But I think this is a point that some people feel when the market's going very strong and we're not keeping up, or you have a bad year like compared to the index like we had this last 12 months, is it feels like the only thing worse than losing money is watching others make easy money. But we're starting to see that's changing now. So don't get too frustrated like I was last year. Just stay focused on what we can control. And the one thing we control is our emotions and looking long term. The last thing we want to do after the last 2 years of pain is to give up on the cheap stocks we own. That would be the worst thing possibly we could do. 50 times earnings is the new 20. I don't think that's going to last, but the amount of people just talking up Fish and Paykel Healthcare at 50 times earnings just amazes me. Very few stocks can justify 50 times earnings over time. Obviously, we're expecting a major rotation from momentum and growth to value, but the market's not going to give up easily on what's working, and we've seen that in just the last 4 weeks after Liberation Day, when the market went straight back to doing what it's been doing for the last 2 years, which is buying CBA and WiseTech and Pro Medicus. But it will change eventually, and the potential reward for leaving the herd at the moment is at an extreme we only see every 10 or 20 years. but we have to put up with this short-term underperformance because we can't afford to miss the turn. If we miss the early turn, then we're going to give up 20% of performance that'll make sure that we only ever perform, average. And we don't want average returns. We want exceptional returns. And the price we have to pay is buying these undervalued stocks and underperforming. And we had 4 incredible years, and I actually can't believe that in 2.5 years we gave up about 35% of our performance. But I don't think we've done a lot wrong other than not sell those resources stocks at the peak. I think everything else has been pretty good. We're just not getting rewarded for it, but it'll change eventually. So that's enough talking with me. Sorry, just one point I would make about the fund that I always want to highlight is people see the liquidity of our ETFs and they don't see much trading there, and they think the actual fund is illiquid, but it couldn't be further from the truth. The actual liquidity of the average stock in the fund is billions. It's not a liquidity thing. All the trading does in the fund is show just how much supply and demand there is for the stock. But in terms of we're governed by very strict ASX liquidity rules, which are, as I always say, the bane of my existence. But if you do ever want to sell your shares, we've got the liquidity there for you, so don't worry about that. That's enough from me, Tom. Your turn or questions?
Yeah, absolutely. We'll definitely get to the questions because we've had so many good ones, and Mitch has been doing a great job also answering a lot of the ones that he can tackle. I'll quickly run through some of the, admin side because there are a lot of questions around that as well. And Nathan spoke about liquidity, and we actually do have a market maker, a liquidity provider in the background, and that provides liquidity for us. The thing about this offer is, sure, it does trade on the ASX, and you can either, still go ahead and purchase it through the ASX as per normal. Ticker code is IIGF. But during this offer, through this offer, and one of the reasons that we run it, apart from bringing attention to it, is that some investors don't use share brokers. So this is their opportunity to get more units in this particular fund. It's an ETF. It allows you to go through this offer, not pay brokerage, not pay that spread. You pay the net asset value in the middle, and you can still transfer them to your share trading, share brokerage account using the HIN. So that's all there as well. The other things I'll quickly just run through: the management fee, 0.97% per annum. And what I'll do now is I'll find some good questions. So one of the biggest questions that we've gotten from people from before the webinar, because you can submit questions before you sign up, which is fantastic, and we've got hundreds of those, and some here in the actual chat as well, is the talk about the 30% allocation to the international stocks. And just to give you a bit more context about some of the questions we've received, this question's about, I know you've spoken about, they're going to be very similar to the ones that are held in the ethical share fund, but will there be crossover with the select value fund, the other ETFs that you manage?
I don't know, can you hear me, Tom?
I can hear you. Yep.
Okay, I can't hear anything, but I'll answer the question on the slide. I seem to have lost audio for some reason. So in terms of the, that sounds like it's kicked in. In terms of the 30% of stocks in IIGF, yes, there'll be some sort of smattering from IISV. We're not going to go. We don't need to go and find new stocks. We've got perfectly fine stocks there to pick from. The one thing I would say though is, don't think that the growth fund is going to become an international fund. It's it's only 30%. If you actually want true international exposure, then you want to be in the select portfolio. The 30% just means that we can just get rid of these, what are actually low growth businesses like Woolworths and BHP. There's a couple of others in there. There's similar sort of ilk that are hardly growth funds, growth stocks. Their best days are behind them, but we're sort of forced into the corner just because of where valuations are at the moment. And Amazon could potentially be trading on a teens multiple in a couple of years, and like that's cheaper than what Woolies is trading at. So I'm so glad we're able to finally make this change, because it's something I've wanted for a decade, and it puts us on an equal footing with the other Fund managers have been doing this for decades. But just in terms of what you're thinking about your own exposure, again, just don't think this growth fund is an international fund. It's not. It's just sort of a better tail end, a much higher quality and lower risk tail end.
And I guess the other thing that we've had a couple of questions about, I'm not sure if you can hear me still. Not at the moment, I'm guessing. Is it a bit...
I can't hear Tom. Sorry, mate.
That's okay. Hopefully, I'll put some other questions up then and see how we go. I'm not sure if it's coming through now. I'll put this one up then from Albie, just saying what might change, if that helps at all.
All right, I'm just going to take the questions off the screen, mate, and hope everyone can hear me because I can't hear anything.
Sure.
I don't know whether maybe these headphones have just exploded. So what's going to change? Well, first of all, we've got the international stocks going in. So I don't want to promise that's going to fix things in 10 months, but when we did this for the ethical fund, the ethical fund had tremendous performance earlier, and then it was a struggle for 2 or 3 years. And we made the change, exactly the same thing, 30% into international stocks, and now the ethical fund's back to its best. So I'm hoping the same thing will happen with the growth fund, but obviously there's timing involved here, and the market's not as cheap as it was 12 or 18 months ago. So that's in one sense, it's a big change because it's a change to the fund, and it means we can own, as I said, much better businesses than what we can own otherwise at much, much better prices. Like, you just don't have to pay 20 times sales and 50 times earnings for great businesses overseas. You just don't. They're 20 to 25 times earnings, and they're potentially better businesses. Not just now, they're potentially better business for the next 20 or 30 years. So that's one big change. But I also hope, going through all those slides, I've just talked about how extreme the valuations are for our resources stocks, for example. But the only issue with our performance is that we hung on to our coal stocks and mineral resources and haven't owned banks. And so we can't control the silly valuations that banks are trading at, but they're going to go down eventually. So we just have to wait. So there's potentially 10% of outperformance there. And if you put 10% of outperformance just from that, then all of a sudden we're outperforming by 1%. So, we actually just have to do nothing. We just have to not own the banks. But if our resources now, which are trading at extreme prices, and we've seen mineral resources have almost doubled in the last month or so. So you can see just this is a small change in attitude towards these stocks, and they can go up a lot. So there's a whole heap of things that I think are going to change. But it's just important to understand why the performance is what it is. Now, if we've just been making mistake after mistake after mistake, absolutely get stuck into us, take it out on me, get frustrated. Yeah, absolutely. That's sort of how I felt last year. But the reason the market's where it is because of these huge distortions, and they don't last forever. Like, we've had these cycles before. They're just slightly different. In the late 60s and early 70s, it was the Nifty 50. It was exactly the same thing that's going on now, but we just didn't have as many index and passive funds back then. So it's just always history repeating. We go through this all the time. 87 was the same, bidding up all the quality stocks. 99 was the tech boom. Like, we just go through this over and over and over. But the thing that's most frustrating is, normally I expect during these periods we're going to underperform not only in the great growth stocks or the Pro Medicuses, but the problem this time is it's the banks of all things where their earnings as a group are actually going backwards, and yet they're trading like they're the most brilliant growth stocks ever in history. So there's nothing we can do about that. All we've got to do is make sure we stick to our process and not own them, no matter how frustrating it gets, because, as I said, the market has a 100% strike rate of pricing these stocks right eventually.
I'll just have a look at this one.
How many people are in my team? So what have we got? 4 analysts and John, who's not a stock picker, but he's our 5th very important person who writes a lot for us in the subscription business. So I'd say there's 4 full-time analysts, and Nick is probably the best investment that Intelligent Investor has made over the past few years. He's been terrific, and I don't want to hang Gaurav out to dry on the resources stocks because he has a better record than just about anyone, which is the reason we're hanging on to these stocks. He's usually right. Eventually, It's just the reason I don't own resource stocks normally is because it's just even when you end up being right, the ride is just so painful. And I don't really want to go through this again. We sort of tried, and I'm happy for us to have maybe one or two of these, but it's just been extraordinarily painful in the sense that it's just been quite extreme where the bank share prices have gone to. If the bank share prices weren't where they were, then our performance would actually still look okay. That's without anything going right for us. Like really nothing's gone right for us in the last 2.5 years, but we're at such an extreme now. Actually, the 20% impact on our returns of not owning the banks and holding these the coal stocks and MinRes, for that to happen again, Commonwealth Bank would have to trade at 45 times earnings, and all those resources stocks I talked about, all 6 of them, would have to go broke. They'd all have to be worth zero. Like that's how extreme the impact of the banks and the resources stocks has been on our portfolio in the last 2 years. And obviously we don't expect that. I told you about all the dividend yields, and this is real cash coming out of the businesses, and the market's pricing these stocks on 6 and 4 times earnings, even though they're buying back shares and paying massive dividends. So I don't know when the change is going to come, but I think I've done a pretty good job of explaining just how much value is in the portfolio, and for the rest of it, we just have to wait for time. So a normal dividend yield. So when I hear normal, I assume that means sort of market. The market dividend yield at the moment, I think, is 3.5%. And actually, the dividend yield of the fund is actually, I think, slightly more than that. As I always stress with our income fund, is we actually want to find stocks that can grow their dividends over time, not just pay the biggest dividends today, which is what most income-focused funds do. But in terms of normal dividend yield, I think the fund right now has a dividend yield of 3.8%. So it's actually higher than what the yield of the market is. But I think the annual fee comes out of the dividend yield, if you like. So it sort of doesn't look like that when you get the dividend receipts. But in terms of what the dividend yield would be in future, I would expect it probably to come down to half of that. One, because we're introducing the international stocks that don't pay anywhere near as high dividends as Australian stocks. But also the reason that the dividend yield is so high is because we've been stuck owning stocks like BHP and Woolworths, which I don't really want to own. They're not growth stocks. They're yesterday's heroes, but it's tough trying to find 25 cheap growth stocks in this market. Like the Australian market only has about 15, maybe 20 great growth stocks at any one time, and most of those are trading at what I think are lunatic valuations. So we've sort of been forced into those stocks. So I actually say the dividend yield is abnormally high right now. As we speak, not necessarily on sort of what the dividend paid last year was, but I'd actually expect it to probably be more around 2% over time.
And we're getting very close again to the end of time. I know Nathan can't hear, but I'll just put up one more question and see how we go.
Yeah, well, this is what we spend our whole life doing. Is if I pick on, I think the difference, like you're always going to have mistakes. Like that's just part of the game. Like even if you're a great growth investor and you're going brilliantly at the moment, like 2.5 years ago when the market fell, when interest rates started going up, there were a lot of great growth investors whose investors were actually questioning them whether they needed to change their process. And now 2 years later, their returns have gone absolutely crazy, and no one talks about that anymore. So you just go through these periods where you're hot and you're cool, and that's just the nature of investing. Depending on if you're a growth investor, you love them at the moment, but you won't like it when the market valuations go back to more normal when the value stocks take over. And we're the opposite, even though we actually do. We'll own RPM Global as a software stock, right? Trades on a huge multiple, but we think it's value. So we're not traditional value in the sense that we only buy stocks with low price to earnings ratios. I think that's absolutely the worst thing you can do in the modern era of investing. It just means you're going to end up with a portfolio of crap. But in terms of that's the whole MinRes is probably a good example. Is the whole reason we own MinRes really is because it has a mining services division, which is basically just a crushing division, which has return on equity of 22%. It's a phenomenal business. But it's just made this big investment like Fortescue did many years ago, where it took a lot of debt to bring the Mount Onslow iron ore mine on. Like there's no other way you could do it. You just had to borrow the money. And it just happened to have come at a time where people are freaked out about resources and China, and the iron ore prices come down. And so, sort of left in this situation where there was just no price low enough for the shorters to keep shorting the stock. And it went from, basically went from $95 to 60 or 55, back to 79 when there was just concerns about lithium. Then sort of the market got over that, and then all of a sudden, it's been more capex for the road and a whole bunch of other little things that have gone wrong. But if you look at mineral resources, its debt is still 2 years away. Like it could have raised capital and still be worth a $30 stock, but it went all the way down to 14, and now in the last couple of months it's just burst, and now it's back to $27 today. So sometimes the market just does really crazy things. But in terms of, is mineral resources a value trap? Well, maybe, but it's got this incredible mining services business. So if we can just get over this hump and show people that, from Mount Onslow, there's been over 40,000 trips of trucks hurtling down that highway. Like, it's just remarkable. And yet all the headlines over the last 6 months have been about 3 or 4 trucks that they didn't actually crash at high speed. They just fell over because they mostly just parked in the wrong spot. So it was driver error, where they tried to get going on the side of the road, and they're so long and so heavy that the trailers just tipped over. If those trucks were hurtling down that highway at 60 or 80 k's an hour and they were flipping, yeah, absolutely. Like that is reason to panic. But MinRes is an example of where there's this extraordinarily profitable and value mining services business that's going to be extraordinarily profitable for decades to come. They've just got to get over this hump and try and avoid raising capital. But obviously you don't expect to get all the governance concerns. Like, that wasn't something we were considering when we bought it. And we knew about lithium, and lithium turned out even worse than we could have imagined, but we were certainly aware of it. We just thought we were getting compensated and the company would get through. But you can never know how crazy the market's going to act. And maybe when it was $14, maybe that's still right. Maybe it's got to raise capital. Maybe the iron ore price is going to $40 a ton. But even I think Mount Onslow breaks even at $48 a ton. So we're nowhere near there. We're at 105. So you just get these strange situations where sometimes value traps, you do end up making a mistake. You pay too much, and something goes wrong and that you couldn't have forecast. But this is a game where if you're right 60% of the time, you're going to have extraordinary returns. And if there was a mistake that I think, or something that could really improve our investing as a team, I think it's that we can actually let more high quality stocks in. I think that's really been the problem. I'm not saying it's come down to me, but since before I left in 2015, all those great growth stocks like the CSLs and the ResMeds, we always nailed them. There was always someone on the team, whether it was like Tony Shenner in the old days, who sort of schooled us young analysts up on these stocks, whether it was Gareth or myself, picking the Nanosonics and all these sort of things. We didn't usually miss those stocks. And then since then, we've missed the Net Wealths and Objective Corps and Zeros, I guess, and the Wise Techs. There's just been a whole bunch of, Pro Medicus is pretty tough. And this stuff isn't easy, by the way. Like, Wise Tech wasn't look very obvious when the short report came out in 2020 and it sunk to $12 or $11. Looks obvious in hindsight, but I still think if I was to say the one thing I wanted to see that was different compared to what we've got now when we go through the next cycle, and the really high quality stocks come down to more rational prices, I'd probably like to see more stocks in the portfolio and giving us more exposure to the likes of the Pro Medicuses at the tail end, because just the profitability and the growth in some of the modern businesses are just extraordinary. And we've, for one reason or another, and I think analyst turnover has been part of that, where we've been giving young analysts too important of stocks, and they're just not mature enough to make the hard calls on them. I think that's really where we could improve our returns in terms of our stock picking. I'm not making that as an excuse for our current underperformance or anything like that, but if I was to improve one thing, that would be it. So sorry, that was a really long answer, but I hope that at least gives you a bit more insight into how we go about picking stocks and just how difficult it is. Like, it's not easy. Yep, so I can see that. So we can't do it until 1 July. We're still needing ASX to sign it off, but normally there's no issues when we do that. So we need to change the PDS, and then we need to let everybody know. So we'll get that done hopefully over the next month or so, and you'll get a letter explaining it. And we'll get that done, and then we'll just pick our I think the 30% will probably be a little bit more diversified. I think if I was doing it 12 months ago, I probably would have just picked 6 stocks and had 5% in each. But valuations have changed for a lot of them. But I'm pretty sure you're going to see Visa, MasterCard, Amazon. You probably won't see something like CME, which has been really good for us lately. I don't want to put 7 or 8% in Fairfax Financial like I have in other funds. It's been a great investment, but it's not as cheap as what it was. So it'll probably be, I'm just guessing and say we'll probably see 7 or 8 stocks at sort of more like 3, 4, maybe 5% position sizes. I'm not sure what the 6% is you're referring to at the moment, but also just bear in mind the best stocks on the ASX typically already have overseas exposure. Like you can't really be a great growth stock for decades unless you conquer the US market, because you're just running, like Australia's just too small a market. The one real exception to that is REA Group. And, it's just been an extraordinary business, just continues to mint money. And every time they go overseas, they blow up everyone's money. So the less time they spend overseas, the better.
I think the international, it might be because of the revenue of some companies like ResMed. But thank you everyone for joining us. And I'll sort of try and tell Nathan somehow that we're going to say goodbye now. But thank you very much for all the questions. And we'll put this up on the website. It'll be on YouTube as well. And we will we'll provide the slides for you, but also upload them. But thank you very much for joining. I'll let Nathan try and say goodbye now as well.
Thanks everyone for listening. If you've got any questions, by all means, let us know.
Thanks, guys. Bye-bye.